Welcome to this video series about measuring value creation in private equity, where we talk about how market multiples drive private equity returns. My name is Mike Reinert. I've worked in the industry for 15 years. I run the AUXILIA Mathematica website, and I wrote the book Private Equity Value Creation Analysis. These videos cover findings from my work website and book, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download the Excel files behind every episode. This is video number 12 in the value creation series, and here we will show you all the math needed to split value drivers into a sector or industry component that is driven by broader market trends or a company-specific influence that can be attributed to a GP or a management team. We will also talk a bit about the kind of market data you need to do this well. The math is indisputably true, but it'll be garbage in and garbage out if you can't assemble reasonable sector or industry proxy data that apply to your deals. Alright, here's a basic value bridge with EBITDA growth, multiple expansion, cash flow generation, and gearing. Now, many of the models in academic studies classify multiple expansion as some kind of broader market influence, but that's a lazy interpretation that's usually unfair to the GP. There are many things that active investors can do to enhance multiple expansion, and measuring it is easier than you probably think. We'll break multiple expansion into two terms. Market multiple expansion gives us the sector or industry influence, and intrinsic multiple expansion tells us about company-specific factors. Positive intrinsic multiple expansion, like you see in the chart, can come from acquiring a company at a below-market multiple, selling the business at a premium, perhaps to a strategic buyer, or materially improving the quality of the company's revenue and earnings. Here we start with the two multiple expansion formulas. The derivative model that we explained back in VC112 gives us multiple expansion measured in dollars of absolute value creation. It's equal to the change in the valuation multiple delta M times the average holding period EBITDA, E, equity ratio, ER, and fund ownership percentage, phi. The logarithmic model that we explained in VC105 gives us multiple expansion as an equity return multiplier. This is simply the valuation multiple at times 2 divided by the multiple at time 1. Now, just as a reminder, these values are basically interchangeable. You can convert the logarithmic model's multiplier to absolute value creation by multiplying fund level value creation by the natural log of the multiplier and dividing by the natural log of a deal's gross multiple of invested capital. Similarly, you can convert the derivative model's absolute value change into a multiplier by raising a deal's gross multiple of invested capital to the power of multiple expansion divided by fund level equity value creation. Despite these formulas looking very different, they give the same answers, generally within a percent. Go back to VC106 if you want to see how the math behind these conversions work. Okay, to start, let's propose the existence of a market multiple, MM, which is a function of time because it changes over time. This is different than a company's valuation multiple, which is denoted with a single M. We'll assert that if a company can grow its own M more than MM, it outperforms the sector or industry valuation trend, and it must create some positive intrinsic multiple expansion. However, if a company grows its M less than MM, it underperforms the market. It must suffer some negative intrinsic multiple expansion. To measure exactly how much, we define a new variable with the Greek letter mu. This is equal to the company's multiple divided by the market multiple at any time t. This effectively makes mu the company's discount or premium to the market valuation, and it means that we can define the company's multiple as the product of mu and MM. Now, the math in VC104 showed that whenever you have a product like this, we can use a bit of calculus to prove that the change in the company's multiple is equal to the change in the market multiple times the average mu, plus the change in mu times the average market multiple. When you add these two values together, you will get the company's delta M. If you want to prove that, just plug in a few values. For example, assume that M goes from 5 to 7x and MM goes from 10 to 12x. The numbers will always work out. Now, when you plug this delta M expression into the multiple expansion formula, you get two new value drivers: market multiple expansion, which is driven by delta MM, and intrinsic multiple expansion, which is driven by delta mu. These two value drivers always add up to the multiple expansion value that you get from the formula up top. The math is even easier over here in the logarithmic model. If the company's valuation multiple is equal to the product of the market multiple and mu, then M2 over M1 is equal to MM2 times mu2 divided by MM1 times mu1. This means that market multiple expansion is simply MM2 over MM1, and intrinsic multiple expansion is simply mu2 over mu1. These two value drivers, when they're multiplied together, they will always give you M2 over M1, which is the multiple expansion equity return multiplier. Okay, let's look at an example. Here's a familiar company that expands its valuation multiple from 5 to 6x over the hold. To measure derivative model multiple expansion, we first calculate all the differences in averages here. Plugging them into the formula tells us that the 1.0x increase in M creates $11.69 million of value for the fund. Now, let's say over the same period, the prevailing market multiples increased from 7 to 8x. Just like the company's valuation multiple, this is a 1.0x increase. However, when we calculate mu, we see that the company is worth 75% of the broader market valuation at T2 versus only 71.4% of the market valuation at T1. This improvement suggests that the GP or management team did something right. They captured more of the market valuation, and the 3.6% increase in mu should lead to positive intrinsic multiple expansion. Okay, when we take that 1.0x increase in the market multiple and the 73.2% average mu and plug them into the formula, we get market multiple expansion of 8.56 million. Likewise, when we take the 3.6% increase in mu and the average market multiple of 7.5x, we get intrinsic multiple expansion of 3.13 million. And as promised, we can add these two together and they give us the expected total multiple expansion value of 11.69 million that we see above. Now, let's try the logarithmic model. We can do that by adding the equity return multipliers right into the chart. We see that the GP fund level equity value increases from 44 million to 88 million. This gives us 44 million of total equity value creation and also a gross multiple of invested capital of 2.0x. Now, the equity return multiplier for multiple expansion is 1.2x, so we calculate absolute value creation by taking 44 million times log 1.2 over log 2x to get 11.57 million. Similarly, the equity return multiple for market multiple expansion is 1.143x, so we take 44 million times log 1143 over log 2 to get market multiple expansion of 8.48 million. And finally, the equity return multiplier for intrinsic multiple expansion is 1.05x, so we take 44 times log 105 over log 2 to get intrinsic multiple expansion of 3.10 million. These last two numbers do, in fact, add up to the total up top, and as promised, the numbers from the derivative model and the logarithmic model are quite close. In this case, you can see that they are within 1%. Now, I know I ran through that math and the numbers quickly, but you can see it all on the episode page, and as always, download the Excel file, which allows you to enter your own numbers and tinker with the models and charts. So that's the math, let's talk about interpretation. Positive intrinsic multiple expansion can come from a few things. First of all, many GPs claim to capture deals with relatively good valuations. This would mean that they find ways to pay a bit less for certain amounts of revenue or EBITDA compared to their peers. If this is true, it should show up as a pattern of positive intrinsic multiple expansion in the value creation models. While this pattern will be less likely for acquisitions that involve top-tier sell-side bankers who run broad auctions, GPs might have a shot at capturing it when there's limited auctions, busted processes, directly sourced non-intermediated deals, or when sellers are in distress. You can also generate positive intrinsic multiple expansion on the exit side. For example, strategic buyers usually pay higher prices than financial buyers, which are just other GPs, so you can get it from a strategic buyer or a financial buyer that overpays. And you can generate intrinsic multiple expansion by materially improving the quality of a company. Note that this does not just mean increasing revenue or EBITDA. Most of that equity value creation will show up in the EBITDA growth value driver or the revenue growth value driver. Here we're mainly talking about improving the quality of revenue or the quality of EBITDA. This can come from reducing volatility in the numbers, improving the rate of growth, or mitigating perceived risks that may come from customer concentration or regulatory issues. The main idea here is that a GP can make a company's EBITDA or revenue streams more valuable. This is often done by changing the mix of products or services that they offer, or changing the company's exposure to various markets or customer segments. When this happens, you should see some positive intrinsic multiple expansion. Negative intrinsic multiple expansion is basically the opposite. You get it if a GP overpays for a business, oversees a material deterioration in the quality of the company, and is unable to position it for sale to a broad universe of potential buyers. Now, the cool thing about this breakout is these value drivers can handle any situation. It doesn't matter if the mu's or the MM's are going up or going down. There are times when a GP does materially improve a business, but the market tanks during the holding period. Here, the model would show strong intrinsic multiple expansion, even if total multiple expansion is flat or negative. The market multiple expansion component would be a large negative number that makes up the difference. There are other occasions where a GP makes a company worse, but it's saved by operating in a hot market. Here, intrinsic multiple expansion would always be a negative number, and market multiple expansion would be greater than total multiple expansion, because the market valuation multiple outperforms the company valuation multiple. Another interesting thing you could do with this is look at intrinsic multiple expansion for companies that have not yet been exited. It can give you some indication of whether the current valuation is reasonable. While there might be some very good reasons that an active portfolio company has a large negative or a large positive intrinsic multiple expansion value, when you see it, it's probably something that you should look into. So that covers multiple expansion, and we could use the same technique to interrogate many other value drivers. Just like we use the market multiple to split up multiple expansion, we can use a market EBITDA to split up EBITDA growth, or a market revenue to split up revenue growth, a market EBITDA margin to split up EBITDA margin expansion, a market gross profit margin to split up gross margin expansion, and a market operating expense margin to split up operating margin reduction. To do this, we simply need to find a reasonable market proxy for these numbers, MM, ME, MR, etc., that will allow us to calculate the Greeks the same way that we calculated mu, and the math will basically work as we demonstrated above. Now, one way to do this is by generating a set of public company comparables, or a comp set. These are quite common in private equity. Here we take 10 different companies that operate within a portfolio company's industry or sector, and we measure things like enterprise valuation, debt levels, valuation multiples, and operating metrics. If you're an analyst at a growth fund or a buyout shop, you usually need to make one of these for every company in the fund's portfolio. And you probably need to update it at least once every quarter because it's a key component of portfolio company valuation. Typically, the most important numbers are the trailing valuation multiple here, the forward valuation multiple here, and these debt-to-equity ratios and levered betas, which are used to calculate weighted average cost of capital, or WACC, needed to run a discounted cash flow analysis. Now, let's assume we had two of these tables, say one at time 1, which is acquisition, and another at time 2, which is exit. This gives us some metrics that we might consider using in our value creation models. Right away, we see a pretty good proxy for broader market valuation multiples. There's a good chance that these are meaningful numbers because these tables are specifically built for valuation. What about the hypothetical market EBITDA that we mentioned in the last section? Well, in a pinch, I think that you can add up all the EBITDAs for the 10 companies and use that as a proxy. If the total EBITDA increases by 40% like it does here, we could consider only giving the investor credit for increases that exceed 40%. This may work for the occasional case study, but I don't think you can usually rely on that. EBITDA values are downstream from both COGS and SG&A, and even within the same industry, these companies can have quite different approaches to creating and selling their products or services. These differences tend to distort the numbers, and I think they make the idea of a market EBITDA less interesting and a less meaningful metric. A better one might be a market revenue. Sales is sales, and the top line of the income statement is less likely to be influenced by company-specific factors. If these are the top 10 companies in the industry and their total revenue increases by 30% like it does here, there's a good chance that the private equity deal's addressable market also increases by around 30%. So this is probably a decent market proxy, but we'll recommend better ones in the next video. Lastly, you might use these tables to estimate margins like a market EBITDA margin, market gross profit margin, or market operating expense margin. These have the same problems as market EBITDA measurements. They're subject to many company-specific factors and therefore less reliable as market proxies. Now, I do not recommend using company-specific comp sets like this for any kind of value creation analysis. They simply do not scale. First of all, company selection is arbitrary. Why did we include Delta Co. but not Kilo Co. in the dataset? Auditors look at these things, and so will your limited partners, lawyers, and compliance consultants, and the regulators might want to dig into it as well. You need to have a decent and well-documented explanations for every inclusion and exclusion, and this becomes quite complicated because the appropriate set of comps is going to change over time. For example, it may turn out that between entry and exit, Juliet Co. goes bankrupt. This changes all the medians and averages, making the two datasets less comparable. Then we learn that India Co. gets acquired by a large multinational conglomerate. Its disappearance also changes the medians and averages. And then we need to consider new entrants. The recent IPO of Kilo Co. changes the medians and averages once again. To be blunt about it, building and maintaining these models sucks. The analyst who's on about a half a dozen deal teams must manage 5 or 6 of these tables every quarter. And that probably requires its own amount of number massaging to account for occasional anomalies like one-time charges in M&A. Not exactly a fun time, but at this point, it's still a manageable task. Things get a bit harder if it's an investor relations professional trying to manage 25 of these models, one for each of the active companies in a portfolio. Let's face it, the fact that they work in investor relations means that they probably don't have the same level of corporate finance ninja skills as the deal professionals or as much familiarity with the companies. So irrespective of bandwidth constraints, we're going to probably start to see some deterioration in quality of data at this point. Now, let's consider the limited partner. What are the chances that they have the bandwidth and resources to do this well for each of the 200 companies in their portfolio? Very little in my opinion, and I think it becomes completely impractical for the academic researcher who's attempting to do something like this for a couple thousand deals in order to deduce broader industry trends. So I propose that any value creation model that requires a custom comp set for every deal is doomed to fail because it will not scale. They are overly complicated and unnecessary because there are better ways to provide better numbers with much less work. especially when it comes to market multiples and market multiple expansion. Market multiples work really well in value creation models because they're ubiquitous. They're intuitive and familiar to both GPs and LPs who talk about them all the time. Because of this, many firms invest significant energy into compiling private equity M&A multiples. Sometimes they even package them into helpful reports and publications and provide commentary about what the trends mean for buyers and sellers. They often include charts that look like this one here, and sometimes they even include very detailed tables like this one, which make an analyst even happier. Get your hands on something like this guy and you're all set. Plug those multiples right into your model, add a footnote to explain where you got the data, save down a copy of the report for backup and future reference, and that's it. No need to build and maintain customized comp sets, no massaging the numbers every quarter to account for anomalies, no need to justify why certain companies are included or excluded, and no need to remember and explain to the SEC why you swapped out IndiaCo with KiloCo 5 years ago. This is one analytical task where it really makes sense to outsource it. Find a report that's published by a respected firm. Do your best to reasonably match the appropriate transaction size, sector, and geography, and then call it a day. Now, the multiples on this page are fake. I made them up with a random number generator, so please don't use them and definitely don't cite me. When I speak to GPs and LPs about sources of private equity M&A multiples, I find that many of them use PitchBook as a source. It's a subscription service, but one to which many of us who work in the industry have access. R.W. Baird's M&A Outlook is another good one that I've used in the past. It's updated several times per year, and it provides some breakdown by transaction size, industry, and geography that can be very useful. Another interesting source is GF Data, especially for smaller middle market transactions under $250 million. They've been working with private equity sponsors since 2006 and appear to have assembled an exceptionally large set of M&A transactions going back to 2003. You can find links to all these sources in the description and on the episode page. Now, you can also use public company data to generate private company market multiple proxies. This does not contradict what I said earlier about avoiding custom comp sets. The key point is staying away from the business of picking companies. Fortunately, you can outsource company selection to smart people who do that full-time for their day job. Mutual funds and ETFs are specifically designed to emulate certain sectors and geographies, so you can let Vanguard or iShares pick the companies for you. You can also build them algorithmically using one of the industry classifications, GICS codes, SIC codes, NAICS codes, and various size or geographic parameters. Now, if you're going to go this route, you probably need to access one of the major commercial financial data providers like Capital IQ, FactSet, or Bloomberg. They would allow you to automate the process and calculate the average or median market multiple for the dataset pretty quickly. I would not try to do this by hand on something like Yahoo Finance. But let me suggest 2 quick points on using public company data. 1, you might want to use a simple moving average of the valuation multiple to smooth out public market volatility. Unlike public companies whose valuations change every minute with share price, private equity valuations rarely change more than once a quarter. And the second point is to try to keep it simple. Don't over-optimize. Reproducibility will be inversely proportional to the length of the footnote you need to explain it. Hopefully you can make it as short as, market multiples represent 90-day simple moving average of the median TEV to EBITDA multiple for the 43 companies in the XYZ index. Something like that is easy to explain, easy to reproduce, and easy to defend if necessary. So that's it for market multiples. If you have any good sources of market valuation multiples, I'd love to hear about them. In the next video, we'll turn to market-driven and company-specific components of revenue growth, which can be described as addressable market growth and market share growth. Thanks for watching. If you're into this sort of thing, subscribe and check out the website AUXILIA Mathematica. Registration is free and allows you to download Microsoft Excel files with all the data and charts used in these and other videos. On the site, you'll also find other resources like articles, templates, and a private forum for Q&A. When you visit, check out the site's free online value creation calculators. These web pages allow you to select various analysis parameters, plug in your own capital structure, P&L, and market data, and then measure value creation with a click of a button. I don't think that these calculators will replace your Excel models, but they're really useful for both preliminary investigations and double-checking that your own spreadsheets are generating the right numbers. I should mention that if you're looking for a convenient reference and training tool with a form factor of a college text, make sure to check out my book, Private Equity Value Creation Analysis, on Amazon.com. And finally, if you'd like to get up to speed with models like this more quickly than the book or the website allow, get in touch. Over the last 15 years, I've helped dozens of GPs build models like this for various fundraising and investor relations projects. Thanks for watching, and see you next time.